Hello, good morning traders. It's 11th of April and today we'll focus on the analysis of three financial instruments, gold, silver, Aussie with New Zealand dollar. All this what happened after the CPI data from USA which we had yesterday. Yesterday's inflation data coming from United States a bit surprised the market. Expectations were month on month 0.3%. It was higher, the same as year to year, 3.7 compared to 3.8 reported yesterday, and this had a really huge impact on the markets. We saw spiking up, dollar getting stronger to all instruments. And why such a situation happens? Yesterday's data show us that the inflationary pressures persist, and it supports Federal Reserve belief that further evidence of inflation moving steadily toward the 2% is necessary. Investors now have fully erased bets of a rate cut in June. Expectations of an interest rate cut at upcoming Fed meetings have really declined sharply and pushed back another few months. When we look at the CME indicator, it shows us that on the 1st May, when we have the next meeting, the expectation that they'll be cutting the rates are none. It's 96% betting that the interest rates will stay like they are. Next meeting, 12th of June, also over 80% expects no cuts. The first change comes on end of July. It looks like half, and when we take a look at the expectation just a week ago, before we saw the CPI data, it was 20% were expecting no cuts, and 1 week later, when we see the CPI data, already 57% expect no cuts. So we can say that the market is expecting that the cutting of the rates is pushed back to the second half of the year, which makes the interest rates will be higher for a longer time. And this what we see on the bond yields is seen here. After yesterday's CPI report, the bond yields has jumped from 4.4 to 4.6 nearly, which shows us that market is expecting that the interest rates will be longer on a high level, which means the bonds must give better return than it was just a day ago. Of course, those expectations of higher rates in United States have impact on currencies, on commodities like gold, silver, and we can see the correlation between the bond yields, which are the green ones, and the blue, it's dollar with yen. We can see that it's strongly correlated, and that's why after the jump in the spike in bond yields, we also saw a spike on dollar with yen. And in case of gold, we know that gold is negatively correlated to bond yields. So when we add gold here to this chart, we can see that when the bond yields are going up, the gold is falling. So generally speaking, things look very positive for dollar and negative for most currencies and commodities. So let's take a look what's happening on gold. Gold was really in a big rally. It was growing. And now we see some signs of bearishness, but it's not a change of a trend. Of course, it might be only a small correction. My analyses are based on a strategy which is called price action and MACD. The idea of this strategy is very simple. When I'm searching for a setup, I'm searching for a pattern. Then I'm looking for a breakout from that pattern, and at the end I'm checking what's happening on the MACD, on the indicator. Is it changing the direction? And in case of gold, we can say there's at the moment no pattern, no inside bar, no outside bar. So, so I'm only looking at the moment at the MACD. And what we must say about MACD, MACD is really strongly extended. It's extended like it was last time, as I checked. It was, I think, 2 years ago. Look, the last time when MACD was so extended, it was in July 2020, 4 years ago. And look what happened then. When MACD reached such a high level, there was a bearish engulfing pattern, and after this bearish engulfing pattern was broken, it means that the price broke out from this area. MACD was also falling, and it was the beginning of a correction. Now, when we look at the charts, we see that MACD is again so extended like it was 4 years ago, but there's still no engulfing pattern. But when we take a closer look at the situation on the 4-hour chart, we can say that there was an inside bar from which the price broke out. So just let me show it closely. I'll remove this blue box and take a look at this. We see that we had an inside bar pattern. This was inside bar pattern, then a breakout, which also looks like a bearish engulfing candle. Here's the breakout from the pattern. They tested today from the bottom, so I believe that there's still a chance for some declines down to $2,300 per. But we must remember we are trading against a very strong trend. We must take into consideration any moment the market can return back to growth. So in case of gold, I would be very careful with shorting it. But a bit different situation happens on silver, where I believe silver gives us a more clear signal for some declines. We see a bearish engulfing pattern, like it happened here, here, and here. All those are typical bearish engulfing patterns. 1, 2, 3, 4, 5, and most of them gave corrections. Those corrections were about $2.5 per ounce. So it might be also such a situation here. Last time when we had a nice bearish engulfing pattern, it was followed by falling MACD. So when we compare it with the rules of my strategy, with the assumptions of my strategy, we have here a bearish engulfing pattern, then we have a breakout, and the breakout is followed by the falling MACD. What we need here is, of course, we need a breakout to the bottom, and we need a bearish bar here on the MACD. Then it might be an opportunity to short, maybe somewhere to this area. But if we take a look at silver from a higher perspective, we can see an interesting situation on weekly chart. When we go to weekly chart, we can say that we have a huge pattern which is called inverse head and shoulders. Look, this one. So we must be also prepared that this is a breakout from an inverse head and shoulders pattern, which might pull down the price down to this neckline, and then again market might go higher. But this is a longer story. When we look at the situation, at the actual situation, I think that we should be slowly preparing for a short, opening a short position, but below this bearish engulfing candle, something like this. Here it didn't work. Of course, no strategy works always, but already last 4-5 times it gave nice correction, about $2-3 per ounce. So at least to this area somewhere we could expect a pullback. So that's my idea on silver. And the last instrument which I found interesting is Aussie with New Zealand dollar. Here we can see that we have an inside bar pattern. This is the mother candle here. 1, 2, 3 inside bars, and the last inside bar here is a candle called doji. Doji usually are called the indecision candles. And I would like to show you what happened during this upswing here. First we had a doji here, this one, and after this breakout to the top, it was obvious that the decision was let's go higher. Then we have another indecision candle, and again the decision let's go higher. And we have another doji, but this time the decision was not to continue this upswing but to make a reversal. That's why I think that this is a first signal of bearishness on Aussie with Kiwi, and it might be the beginning of a downswing. Looking at the MACD, definitely MACD is supporting that idea. It just started falling, so I think that a big chance for a short position to 108.30, because this is a resistance level which also served before like a support, and it might be again, so be aware that this might be the target, and then market might go again, follow this upswing. What else can I say about this instrument is that it's really nicely working with the MACD. Look at the moments when MACD is reaching a high level and then it starts to fall. It gave us nice signals for downswings, and also opposite, when we saw MACD being below the zero line and changing the direction, it also was a signal for an upswing. So it might be that this is just the same situation like here, and it could give us some decline. So I believe in MACD, and I hope that this idea will work like I expect. And that's all for today, but remember that we have two important events this week. In 1 hour and 20 minutes from now we'll have the ECB rate decision, which might be a volatile event for euro and euro pairs. Then we have a press conference of Mrs. Lagarde, which might be even more volatile than this decision, because there's no expectations and no change. But it's important what Ms. Lagarde will say, what are the plans for future of the ECB. And of course tomorrow we have the GDP from Great Britain. This is also something which will have impact on pound and pound pairs. And that's all for today. Thank you. See you next week.